Gather round. It's time for your Real Estate Chalk Talk with the Hittner Group. Listen closely as your coaches discuss the culture, the economy, and the political scene, and how it affects your home and your real estate investments. Real Estate Chalk Talk is where you learn the science of buying and selling real estate and the art of living in your home. Your education begins in 5, 4, 3, 2, 1.
Hey there, welcome to the program. This is your Real Estate Chalk Talk with the Hittner Group, hittnergroup.com, 612-627-8000. That's 612-627-8000. Give us a ring-a-ling-a-ling. Happy to have a chat with you about your real estate needs. And, of course, that call is with no cost and absolutely no obligation. And so we are entering into another lovely week of real estate, week of January 22nd.
A little cold last week to be out looking at homes.
A little chilly. It does.
Wow.
It does have an impact too.
I think it does, right?
Yeah. Oh yeah, for sure. Because who wants to go out? But we got some activity anyhow. Active listings 5,142, up 10, or no, down 10. 5,152 last week, so we lost 10. Went backwards. 107 at the beginning of the year. Last year in 24, we were at 281 increase for the week. 4861 increase. 4861 new listings.
New listings?
New listings in this week of last year.
Okay.
So we're up a little bit, 281 up.
Is that
about
what
a 5% increase?
Is that expected this time of year?
Well, it's nice that it's an increase over last year.
Yep.
I mean, we would expect properties to be coming on the market, but the increase is what we're looking for.
Okay.
So, again, it's more inventory coming on the market, longer days on market. And so I think we're in a kind of I almost want to say a stable real estate market, pretty stable. Yeah. Properties need to have their time on the market, some of them longer than others.
Are you still finding, last week when we talked, Keith, I think you said they were like average was 51 days or something. Are you still running over a month?
Over a month.
Yeah.
Yeah, well over a month. Right. And some of them, remember, that's the average. So that means that there's a bunch of them that are like a lot more than that.
Yeah.
And some of them, like especially new construction, kind of throws into that because they're not entered until they're sold. And then all of a sudden they go sold before a list, so that 0 days on market. So that really brings that average down. But I think that we're starting to see. I think 60 days is pretty good.
Okay.
Yeah, you're going to see lots of 60s.
What factors that, Keith? Is it probably location, condition, normal stuff?
All the normal stuff.
Okay.
Price, condition, location is all the thing. I think we're seeing that properties that have some hair on them that need some work,
right,
are taking a heck of a hit from a pricing standpoint. I mean, they're really taking a whacking. And sometimes you're just not, especially with our probate listings. I mean, we've got, an 85, 90-year-old person that's been living in the house, basically just existing in the property for the last 25 years. They're not doing anything. They're just living there. And so you come in, and it's like, well, what can we do to get the value up? Well, and the conversation really is you have a lot of deferred maintenance.
Yeah.
So there's things that you should do, but it doesn't improve the value. It's stuff that you should have done just to maintain it.
Yeah, it just gets you to where the value should be. Right? Versus like, we're getting a premium on this home because you did X, Y, and Z. It's like you want to just get that where it should be, right?
You're exactly right.
Okay.
So, and when we look at properties, say I look at 20 properties that are similar to the one that I'm trying to price out. Okay, all of those properties, our assumption is they've been prepared for sale.
Right.
Okay.
Yep.
So, I mean, they're clean.
Right.
The carpet's good, the paint is good, the appliances are good, the roof has got life on it, it's got some decent siding on it. And so then when you don't have that, the delta is a lot. And you're going to find.
So, can I ask you a question on that? Because
Sure.
I know you had a property in Minneapolis. Where do you draw the line on what is deferred maintenance and what is like you have to do, and then what is, hey, this would enhance or at least get us some offers? Because you had a property where you I think it was a probate deal, and it was okay, but it wasn't great. And then it didn't move, and then you did some things, and now you increased pricing on it. How do you make those decisions? Because it seems like a crapshoot. Like, I don't know,
Well, I'll give you an example with that property. So we put a new garage door on it.
New garage door.
Okay, so it had a garage door. We put a new garage door on it. Did that increase the value of the property?
No, I expect a garage door.
You expect a garage door.
That's functioning well, yeah.
Right. So the old garage door was not functioning well. Okay, so now the new garage door is functioning well. It's got an opener. The old one did not have an opener, so that's an improvement. But how do you measure that? Because people expect a garage door, and in today's market, they expect an opener too.
So did the seller in that case think that they were enhancing the value of hey, we should be able to get more now because we have a garage door opener?
Not in this case. In this case, he knew that the garage door was just because he's trying to get in and out of it. He's fighting with it all the time. He said, "I got to put a new garage door on here." My brother should have done it, and then. So we they had some old, carpet. It was worn out. And so we pulled that out, and there's these nice hardwood floors under there.
Of course.
No, they've got some stains on them and some water stains and all that. So we sanded the floors, stained them, refinished them. They look fabulous.
Really?
Okay, so now that's an improvement.
Yep.
Sure.
That's definitely an improvement. And then in the bathroom, you couldn't use the bathroom. So they're around the tub surround was all cankered out, and water, would splash up in the tub and it'd go downstairs. I mean, it was just, there's no seal there at all. And then the floor was curling up, popping up, the vinyl and all that.
Yep.
So we pulled that up, put a brand new floor in, nice vinyl plank floor.
Okay.
And went all the way back to the studs.
Oh, wow.
Re-insulated the walls, put the Durarock up, put a new tub surround on. So now someone can come in there and live there. Because it's functional and it looks decent, and so that added value. Now, did they expect a bathroom? Yes, they expected a bathroom. Yeah. So how much value did it add? Well, we had it priced according to condition.
Okay.
Right, assuming that someone was going to do that, and by the time they got done with all their stuff, they're going to have, a property that's worth $350,000, and we're selling it for $300,000. So I think that's $50,000 you got to work with.
Okay.
Do a rehab loan and do your work. The dilemma that we have, we had two things: time of year.
Time of year hurt. Yeah.
Time of year hurt us with that, and most people now, it's funny, they just don't want to do any of that stuff.
Well, in the fourth segment, we'll talk. I had an investor client that pulled out because there was. We'll talk about it then, but dirty carpet and a shower head going to have to be replaced. I really don't want to have to do that.
Yeah, and that's a so-called investor.
You're an investor.
Yeah.
First one. I'm like,
they're not an investor.
Yeah. You should never do this again.
They shouldn't do it
ever.
So we've got listings on the market in 2024. We had 53,626 listings that were listed in 24. In 23, it was 49,397. So 4,000 more properties were available for sale in 24 than 23. And I think that we're going to find that number is going to increase in 25. I think we're going to have more properties available and longer market times. But as far as the selection goes to a buyer who is looking for a house, we're not having any trouble finding properties.
That's good
to look at. I mean,
so balanced market, seller's market, buyer's market.
I think it's pretty balanced. I mean, it depends on the property, like anything does. If you've got a really sharp property, clean as a whistle, great neighborhood, you're in the driver's seat on that property. If it's got a little hair on it and not so great in a neighborhood or whatever it is, maybe the buyer is going to have a little advantage to that, because you look at the comps based on what's going on in the mile. You got to look at what's going on next door. What's that property next door look like? Because that's what the new homeowners come home to every night.
Right.
And if next door is a disaster, junk cars in the driveway, and all that really impacts saleability.
Interesting.
Yeah.
So many things, right?
There's so many things. So when we come back, we're going to actually hit on some stuff with this insurance market. I got a story I want to tell about insurance. Dave Rogers in the studio. He's going to give us the full Monty explanation as to why these costs are going up so much in insurance.
I've got one question before you go out.
Okay.
What are you seeing on seller concessions right now, Keith? Just to
About half the time.
About half the time.
About half the time.
Some of the sellers are contributing towards like closing costs, discount point, just helping. Okay.
Yeah, and that's not necessarily just coming off the top. Sometimes you see a little increase in the purchase price to accommodate that. And also remember that you're seeing the buyer agent's commission on the purchase agreement. So when the seller is looking at their net sheet, they see that line item of 2.5%. Then they see the line item of 3% seller concessions, and they're starting to say, wait a minute. Why am I giving up 5-6%?
Like you used to.
On this deal. Well, it wasn't the line item.
So
it wasn't the line item. That's it for this segment. This is your Real Estate Chalk Talk with the Hittner Group, hittnergroup.com, 612-627-8000, 612-627-8000. Check it out. We'll be right back. Hey, welcome back. Thanks for sticking around. This is your Real Estate Chalk Talk with the Hittner Group, hittnergroup.com. Junior's off in Key West.
Key West.
Yeah,
I think you said
yeah,
right?
Key West.
That's what you said, yeah.
Down in Key West.
Where do you fly? I don't know where.
You
sounds dumb, but I don't.
You fly into Chicago, O'Hare, change planes, and then you fly into Key West.
Where's Key West, though? Florida?
The southern tip of Florida, southernmost city in the country.
Oh, really?
Mm-hmm.
Okay.
Yeah.
Nothing direct?
Well, depends on which
From
airline.
Minneapolis?
Yeah.
Well, if you went Delta, possibly. I suppose.
Yeah.
A lot of them go through Miami.
Okay.
I know, jump seat there.
Yep.
All right, so he's down there having a little R&R. That's good. He's warm. He's in warm weather down there, 65 degrees and rainy.
Is that what it is?
Yeah.
Oh, that's great. That's awful. I shouldn't say that, but that's.
No, that is great.
You would take it?
Yeah, 65.
No, we want to dig it in on him a little bit, right?
Exactly.
Give him the needle.
Okay, so we're here. I got a story to tell. So I'm got this detached townhome. I bring it on the market in Eagan, and it's great. It's really nice. Master suite on the main level. It's a Rambler, and nice big kitchen, nice appliances, granite countertops, beautiful property. $415,000 detached townhome, and I'm out there, and the neighbor comes over, and a delightful gal, and so I'm chatting with her, and she said, well, the association management company has changed, so it's a different management company now. Okay. And she said, and the dues went up. The dues went up to $440,000, 440 or 444 or something like that. Up $105,000, $105 a month.
Yep.
105, and it's all insurance.
Yep.
All insurance. So then we had a busy open house. So people were in and out, and pretty soon her husband comes over. And he's a nice guy, so I'm chatting with him too. And he said, well, our HO6 policy is $850 a month for his HO6.
Yep.
And it's like $850 a month.
Jeez.
I remember when they used to...
Not a month, a year.
A year.
Yep.
I remember when... Yeah, thanks. I remember when they used to be like $120.
Oh, yeah.
For HO6. So first explain what that HO6 is.
Sure.
And then why the increases in all these insurance costs.
So your HO6 policy is for people that own condos and townhouses where there's an association that has a master policy that's covering the building.
Okay.
So, and each association will have a different master policy depending on whether they're covering just the shell. Do they cover from the studs in, sheetrock in, or as is? All those are different policies that are going to cover those units differently, and it will require you to have different coverage depending on which of those master policies that you have. So if you have an all or an as is policy, so the day you walk into it is how they would replace or rebuild that per the master policy.
Okay.
Sheetrock in, studs in, that's all they're going to do. You're responsible for the rest of that interior. So depending on what that master policy is and what their condo policies have, their HO6 policy is having to cover, that could be a big reason for that increase in cost, because maybe they're having to rebuild the entire interior and they're now having to have more structural coverage just themselves in addition to the personal property coverage.
No, I thought, see, I just learned something, because I thought it was a matter of the deductible.
Nope.
Oh, it isn't.
No, so you do have that loss assessment coverage as well. And unfortunately, we're finding in the market right now that is a huge loss leader for insurance companies, which is why that HO6 policy also may have gone from that $200-300 to $800. Is, you know, you've got a $25,000-$50,000 loss assessment coverage. Well, that's a huge burden for that insurance company on an $800 premium. You know, that if, let's say they've got 4 or 5 units in there that they're insuring, you know, all of a sudden they're on the hook for a couple $100,000 for very little premium. Now, obviously, we're pulling the money and they're still able to pay it, but you're seeing carriers go away from that $50,000 high end. We've got one carrier that the maximum they have on their HO6 now for a loss assessment is like $5,000 or $6,000. You know, so
what is a homeowner to do?
Well, they either have to have a good savings account or find a different carrier. But again, those carriers are getting away from the $50,000. You're seeing most of them max out now around $20,000-$25,000.
So when you have an HO6 policy, it's critical that you marry that thing up with the master policy.
Absolutely.
And you don't just go out and buy one.
Yeah, your agent, you really need to know what's covered on your policy and what's not covered. You need to know what that master policy is covering. You know, is it an as is it sheetrock studs in? Is it wall? I mean, you need to know those differences and have a good explanation so that you are a wise shopper when you're looking for insurance to cover your personal belongings, but also the residence you're living in.
So if you're unable to cover that grip, that difference, from a lending standpoint, Kelvin, what happens there?
If you can't cover what?
The difference between the HO6 policy and the master policy.
So let's say my HO6 policy is only covering $25,000 and it's a $50,000 deductible. What are they going to do?
You have to have You have to have that rider on it. We just had one of those.
Have what rider?
A rider, the loss assessment rider.
Right.
So
but
the gap.
Yeah, but what about that gap though? Like that 20 to 25,000.
The max they'll do is $25,000, and the loss assessment is $50,000. You got a $25,000 gap there.
Well, I don't think we'd lend on it, to be honest.
Really?
Yeah. Without a large savings account.
You got to have something that's going to make up.
Could you
gap.
put it in reserves and make sure? And
Doubtful.
No.
I think you got to be able to match that. We have everything covered.
Could they go to a second company then and get 2 policies?
Not yet.
Almost like reinsurance?
Yeah, no, I haven't seen that yet. I mean, it may be coming possibly, but you've got just the losses available on those structures. I mean, all that asphalt shingles, all the vinyl siding and stuff. I mean, that's just a huge gap that they're having to cover, So it's definitely a difficult market. I mean, you can find those coverages out there. There are some carriers that still have it. I've got 2 or 3 that still are at the $50,000. But not a lot of them. Several of them are dropping down.
What do you?
That's going to be a problem because the ones I'm thinking through right now that we've had, I'm like, God, if I run into that, but it's always the loss assessment will bring them up to the amount of the deductible piece. So
well, and the other thing to consider too is let's say there is in this scenario here where it's a detached townhouse, right? So let's say the master policy deductible is $100,000. They're really hoping that there's multiple units affected by that. But if it's only one unit, let's say the one unit has a fire and burns to the ground, that's a $100,000 deductible for that one unit.
Okay.
So now,
storm loss where you've got maybe a half a dozen.
Yeah, you're spreading that deductible out over all the units. Whereas if there's a larger deductible, where you're seeing that, especially in this market, where each unit could potentially have, if there's just one unit affected, $100,000 deductible.
Wow.
So it's a tough market. There's a lot of questions that are going to start coming up, and unfortunately, it's going to start affecting mortgages and people's ability to buy homes.
So, as an insurance professional, then, and you are visiting with other professionals across the country, what kinds of things are you hearing rumblings of to address these issues? And are the insurance companies just kind of staying mute on these things, or are they actively working to address them?
Well, the insurance companies, at least from what I'm selling and the availability offerings that we have is no, they're actually looking at decreasing their loss assessment coverage because it is a huge exposure. You know, because again, they're looking at $800-900 in premium and a $50,000 payout, you know, for a weather event.
Right.
Whereas, you know, on a homeowner's policy, yeah, that, you know, if you're getting a new roof on the average home, it's probably $25,000-30,000 for a roof versus $50,000 for a loss assessment. So there's quite a bit going on there where they're hoping, you know, to get to those points where we have good conversations with these carriers that are writing these structures that they have to lower their deductible, but obviously their costs are going up too because to replace all those roofs, it's not cheap either.
Yeah, most of it,
So,
I
mean,
would.
there's just there's a balance there. It's a tough balancing act right now.
I would guess you got the management company and the board of directors is raising their deductible to get their premium
To save
down,
their costs, yeah.
to get
Right.
the premium
Yeah.
down, but they're leaving everybody kind of in the lurch there.
So it might have to come down to where these management companies are going to have to start banking money to cover those loss assessments.
Oh,
Or to cover that deductible. You know, my parents live in a townhouse. Excuse me. They live in a townhouse association as well. I know they have a fairly large savings account that they actually went through and they replaced all their own roofs and all their own siding. You know,
Really?
so yeah, I mean just so they got ahead of it to keep their their insurance costs down. So that might
That's
be something
interesting.
they have to do.
so that is an option for an association if you're being forward thinking,
Yeah.
is to pool those monies and then they can cover those.
Yep.
Those
Yeah,
gaps,
that might be
those
that
gaps.
might be one way we have to look at it in the future.
Your Real Estate Chalk Talk with the Hittner Group, 612-627-8000, 612-627-8000. We'll be right back. Welcome back. Thanks for sticking around. This is your Real Estate Chalk Talk with the Hittner Group, hittnergroup.com, Hittner Group, all one word, hittnergroup.com, 612-627-8000. All right, so I'm thinking in California, you hear estimates anywhere from $100 to $200 billion to replace those homes, all allegedly to be covered by insurance and insurance costs. First of all, just think of that project
Oh yes.
to go in
huge
there,
project.
and it's still burning.
Yeah.
You know,
New
so
fires popped up this morning.
yeah, so they're not done burning it yet. Maybe they would thought during the slow time when it slowed down a little bit, they should maybe get some water out there, but they haven't done that yet. So what are the insurance companies? I mean, doesn't that like bankrupt them?
No. So the insurance companies have to have significant reserves, obviously, for catastrophic events. But they also have, you brought it up earlier, reinsurance. You know, so they do have reinsurance, and obviously this is going to be a huge reinsurance event.
Explain that. Reinsurance.
So insurance companies go and buy insurance to stopgap their losses. So
they buy insurance on insurance.
they buy insurance for their insurance. Yes. Yep.
Interesting.
Yeah.
So, well, again, we'll pick a number. I'm not sure exactly what that number is going to be out there, but I'm sure it's probably $500 million to $1 billion. Right? Is the stopgap per carrier, right? So once they hit $1 billion in losses, then the reinsurance will kick in.
Okay.
So we all pay that, right, through our homeowners, through our auto insurance. All carriers buy reinsurance.
Okay.
And that's a national rate. So through our homeowners policies, we are actually going to be helping out a little bit in California because the reinsurance rate is a standardized rate.
So who are is it like Lloyd's of London or somebody? Or
Or is
who-
Yeah,
it
you got
government?
Swiss Re, you've got Lloyd's of London, there's other big carriers that carry that, yes.
Okay.
So, and that's what they specialize
that's
in.
their business.
Yep, that's their business. There are specific reinsurance companies that's all they do is reinsurance for carriers.
God, there's so many different businesses out there.
Oh,
aren't
yeah.
there?
Well, there is,
Man,
and then
I never thought about that.
Yeah.
I thought it was maybe backed by the government or something, but no.
No.
Because
Nope.
what about all this federal aid? They're saying it's going to cost the government $1 billion. Da 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 da.
Well, remember
where does that go?
There's infrastructure that got burned down too. So there's firehouses that got burned down. There's clinic. There's a lot of infrastructure that got burnt down as well that has to get rebuilt.
And then you're going to have federal loans too kicking in because not everybody's going to have enough insurance to cover their house. So
Okay.
they're probably going to have to apply for federal aid or something to get that stopgap loss, or kind of like what they do in the St. Paul neighborhoods. Hey, we want you to live here. We want you to stay here. We'll give you X amount of dollars if you stay here for 10 years. We deduct that off. It's kind of like a grant and stuff.
Okay.
So I'm sure you'll see a lot of those things there. But yeah, you've got 25,000 structures
Mm-hmm.
that have burned down. That's a lot. That's a whole city you're rebuilding.
Yeah.
You know, here in the metro, I mean, that's a city. And there's a lot of coverage that's, you know, unfortunately people are going to be short on.
So you think of, well, we should be empathetic towards the people that have gone through these disasters and whatnot, and that's true. But there is such a thing also. I call it toxic empathy, and where you are paying the freight for people who were not adequately insured.
Yep.
They didn't meet with their guy.
Mm-hmm.
You know, they didn't stay up to code on their house or whatever.
Yeah.
And so now there's a disaster, and now they're looking for somebody else. Another example of that is first-time homebuyer money.
Yep.
You know, that's another toxic empathy there. It's like, well, everyone should have a home. We should help them. It's like, you know, the truth of the matter is maybe everybody shouldn't have a home.
Yeah.
You know, maybe, you know, they should rent because they're not cognitively able
Sure.
to do what it takes to own and maintain
Yeah.
a property.
Home, yeah.
You know, so, and we see it all the time. They'll get in on one of these programs, and you know, in 2 years the place is a disaster.
Right.
And then, you know, then they're out and they're back renting.
Yeah.
You know, just because they can't maintain it. So
Toxic empathy. Never
Toxic.
heard that
That's
before.
that's a
good
good
term.
too. Yeah.
and
Did
then
you think of that all on your own, Keith?
Yeah. And then we have we're talking about understanding the real estate market. This all ties into it because the real estate market. First of all, it's 25-30% of our economy is tied up in real estate in one form in one form or another.
Absolutely.
Either the mortgage side, the insurance side, all that. You know, it's a huge thing, and there is a certain inertia in that market. And people will ask, you know, what's the market like, and you know, what's the trend, where is it going, and really, you can look back 6 months, 3 months, and see where it's been.
Yep.
And because that's a pretty good indicator of where it will be in 3 months, because the inertia is bringing it forward until there's something that it's physics. You know, an object in motion tends to stay in motion until it expels its energy. You know, at what point does that kind of run out? I mean, we're kind of seeing that run out now. We had tremendous inertia created by 3.5% interest rates.
Right.
Created a lot of inertia. That went through 4%. That went through 5%. There's still that inertia there. All of a sudden, we get 6%, and it's like, ooh.
A little bit. And then we hit 7.
And hit 7.
Now we're flirting with 8.
Now we're flirting with 8.
Or we were. Now we're not. But
that's
we
the
were,
pressure. That's the pressure on that to stop that. Well, once that market slows, now to get it fired up again is a huge deal, because it doesn't just fire up overnight.
Right.
Yeah.
You know, so
Well, you're not going to see insurance costs come down.
no.
Right? You're not going to see, we talked about this at coffee, you're not going to see insurance costs come down. You're not going to see construction costs come down. So it's not going to be there's a sale on homes. Congratulations, everybody. No.
Well, you've got 25,000 homeowners plus families now displaced.
Right.
Where are you going to put 25,000 families?
You imagine just working. And this sounds
Yeah.
weird, but I
Oh,
think
yeah.
about if my house burned down, do I go to work the next day?
Right.
Yeah.
Yeah.
Do I not? And all of us in this room are paid based on what we produce.
Yep.
Right.
Well, now what?
Mm-hmm.
Right? It's unsettling,
Yeah.
right?
Well, you're talking about, like I said, you're talking about that inertia. You've got 25,000 families displaced. Where are they going? Where are they going to live? Where are they going to reside? I mean, that inertia in California is going to be quite interesting.
Yeah,
I
it
mean,
is
there's
gonna be
there's a catalyst right there for their economy,
Right.
for their real estate market, good or bad. I mean, I never wish this on anybody, but what's going to happen there?
Well, you see right now there are people in those burned down neighborhoods selling lots
Oh yeah,
because the homeowner has no intention of rebuilding there.
Yep.
But it's a desirable neighborhood, so they're selling lots.
Are you serious?
Yeah.
yeah.
So they're selling the land because
Wow.
someone who is more affluent and has the resources is going to come into that desired neighborhood and build a house. So I think you're going to see a tremendous amount of churn in that neighborhood.
Wow.
In terms of the,
I didn't
the
think about
resident
that. What
mix.
what an opportunity.
Gentrification, is that what they're worried about? The gentrification, where they're
It's too big of a word for me.
Yeah, that's too big of a word for me too. Where the rich people get to buy all the houses and the poor people get to keep booted out.
Pretty much, yeah. Or the Hispanic Latinos, whatever, that used to be their neighborhood.
Yeah.
But it's a desirable neighborhood, and now
they're out.
They're out.
Mm-hmm.
You imagine if you had a ton of money, Keith, you just be walking around saying, "Hey, are you interested in selling
checks?"
Yeah. You're just writing checks and taking properties.
Right. Buy a whole city block up.
Wow.
Build a big McMansion.
So if you're out of town next week, I know where you are.
Yeah.
I'm actually in California next week. So
oh, yeah? What are you doing out there?
Just a Loan Depot meeting.
Okay.
So
that's the kind of thing that impacts the real estate market. Is all of that stuff.
Yeah.
It isn't any one thing.
Right.
People are always looking for the one thing, and there is no one thing. It is such a complicated a mix of pressures and movements in the economy that makes real estate go up or down or sideways or one way or the other. And then housing styles themselves, then you bring in the aesthetics, the aesthetics,
the home, the location,
the
condition, all that.
Yeah,
right?
all adds in that. So understanding real estate market trends is not an easy thing. You can look at it and you can get some big, broad, sweeping things, like prices are going to go up. I don't think that anyone. I had a conversation with someone yesterday and thought, well, are prices going to come down now in real estate? That's like wishful thinking.
Yeah.
People are always saying, are prices going to come down?
Right.
I'm kind of waiting for prices to come down. It's like, what makes you think prices are going?
Do you think they
down?
come down in any price range or style of home or age of home? Like, are there older homes that?
Well,
might
there's
not
always
have...
that. There's always functional obsolescence where that property is going to sell, for less. But on the whole, market on the whole, the pressure on pricing is up.
Right.
Is up, and even those.
But then you go meet with somebody and they want to list their home, Keith, and go, well, it's not really worth what you think it is because of this.
Well, that may be true. People
You know.
still have unrealistic expectations, but the thing of it is that it's like, well, it's worth 175, and you go 175. Holy cow! I thought it'd be worth 250. Okay, but your dad paid $40,000 for it.
Yeah.
Mm-hmm.
So 175 to 40, pretty good.
Very good.
Pretty good.
Yeah.
So there's that, and now you get into the deferred maintenance and the location and the functional obsolescence of the style and all those kinds of things.
Yeah.
So we got to head out to break. When we come back, we're going to do a big money segment of the program. That's the one everyone's waiting for every week.
Every week.
The money segment. We'll be right back. Hey, welcome back. Thanks for sticking around. This is your Real Estate Chalk Talk, the big money segment of the program. Kelvin Kamick, ladies and gentlemen.
Turning my volume up now.
651-231-2500. 651-231-2500.
You got to make sure people hear you, man.
Yeah.
I know. Turn the volume up so everybody can hear me.
Turn the volume up so you can see better.
Yep. And they don't hear me coughing. Coughing a little bit. Sorry about that.
That's it.
Give me a real quick recap on the real estate market, if you
Quick recap. 5,142 homes on the market right now. That's down 10 from last week. A little bit of a dip. That's up actually 42% from 2022. 42% increase in the number of units for
That
sale.
seems odd, doesn't it?
No.
That's up 40%. So listings are up 40% over a year ago.
Over from 2022, 2 years ago.
Oh, 2 years ago.
Yep.
Okay.
And we got absorption rate, just as a little fun thing here. Dakota County 1.53. That means if not another house was listed, it'd take about a month and a half
to sell out.
To sell what we've got.
Okay.
And Carver County, Scott County is 1.78. Carver County is 2.2. So it's going to take over 2 months to sell what they've got on the ground right now, if nothing else is listed.
So what county has the most inventory then? Carver?
Well, that has the slowest turn rate. I don't know that it has. No, Hennepin County would have the most listings.
Hennepin, okay. Do you have the Hennepin number?
I don't know. 1.45.
Okay.
Yeah.
So about around
a month and a half.
Yeah, a month and a half worth. That seems like a really balanced market.
Yes.
Right.
Yes,
so
I think so too.
No, the sellers aren't winning, the buyers aren't winning. It's kind of pretty balanced out.
Right. It's an arm's length transaction, arm's length negotiation, like it should be.
Well, let's talk real quick about what's happening in the mortgage market, and that is nothing. is
Really?
really happening. Yeah, we haven't seen any real increases. The headlines were, we've had a week of no increase, no decrease, right? We got a little bit better, and some people see a headline here and there. And as we talked about last week, every given day I can show you two headlines that contradict each other, but rates haven't moved a whole lot. We hope to see rates, get down a little bit, but as we talked about last week, everybody's anticipating that, maybe with quotes around it, rates will get into the mid sixes, maybe low sixes by the end of the year.
What's the mood? Is there a Trump effect out there, or what's the mood?
I think I don't know, the mood is, generally the mood is there. I see so much more optimism just in terms of what's happening. And whether you're left, right, I don't really care. But you can't deny the optimism that some people are feeling right now. Like, okay, we're doing stuff. And if you look at what happened even just this 1 week, really basic stuff that I think the three of us could write down. Like, hey, what are some basic general principles that we should have? And all Trump's doing is implementing basic strategy, common sense stuff that you just go, okay, it's baffling that we have to say certain things. Right? It's baffling that we have to identify how many sexes there are. It's baffling that we have to talk about the fact that we probably shouldn't let bad people in the country. It's there's just basic things that I'm happy that are just being said, done. Let's move on, and let's just move on. So, is it affecting mortgage rates? Not really. No, I mean rates are actually not great yet, right? I mean, we're still, if people are being honest, and I know way too many people in the industry, and we talk like, hey, what are you quoting? Well, I'm quoting like 6.99 or 6.875. Where are rates? About 7.375, 7.5. Like, okay. So everybody's lying by about 3/8 right now. Okay. So I should actually have that be the segment. Like, here's the lie factor for the
right.
Here's the gap. Now you can get there and stuff like that, and we do, and we're going to talk about here in a minute just how we're helping people just transition into maybe what that higher payment's going to be. But
I have a question for you. You have the 2-1 buy down.
Yep.
So that buys the rate down 2% for the first year. Am I right?
Correct.
And then the second year it goes up 1%.
Correct.
And then the third year it's at full market.
Your full market rate. So if rates were at 7, let's say rates are at 7, we start at 5, 6, third year we're to 7 where that rate is. And
so that's pretty affordable.
Well, it's the first year it's a $400. I've got a average deal, right? So $450,000 purchase price, 20% down, $360,000 loan. It's a $471 per month savings year one.
Wow.
Year two, it's a $240 savings, and year three, you're just you're there.
You're at par.
So what are you paying to get that then? To get that savings?
2 points.
Okay.
2% of the. So if we were doing a deal, Keith, and you said, I would say, hey, can you get me 2%, right? Because then we can use some of that towards getting that, doing the 2-1 buy down, have a little bit left over to hit some closing costs, but. That's how we're doing it. We're not recommending that, hey, come out of pocket with that additional money, because what you're doing is you're basically just forwarding that dollars. I did it when I bought my house, and I did a 1.5 buy down. So in the first year I'm 1.5 points lower, then I'm a half point lower, because I like that one the most, because the cost for that is like 1.25%. So it's like, okay, that's reasonable. Like I can usually get 1% out of the deal.
Yeah.
We're offering right now, anybody that calls in or talks says, hey, I heard you on the radio show. If you mention the radio show, we're doing a 1.0 buy down. We'll go 1% under. We're doing that for free right now.
1.0.
Yep, 1.0. So if it's 7, we start at 6 for the first year, then you're at 7. So a 1.0. So
and no cost.
No cost. We're just doing it because you mentioned the radio show.
Okay, super.
Because we need to know that somebody's listening. So
okay, so then
please,
on that 2-1 buy down, it's 2 points.
Yep.
What's the additional cost to say, look, I'd like that 2 points to be permanent?
A lot.
Is it?
It's a lot. Yeah, we did. It's like $13,000-$14,000.
Oh wow.
Yeah. So you wouldn't do it. Yeah, I mean I'll do it next week. I'll have.
Would it make more sense just to put that money down?
Yeah, it'd make more sense to just have that money in your emergency fund. Yeah. Don't do that. I mean, people. We talk about these grant programs, and we had one this week. We're working like crazy to try to get them in, and I mean, we're taking shoehorns. Remember the old shoehorn? You're trying to get your foot in that shoe. That's how I feel. Like, I'm just like this. If something goes wrong, I don't know how these people are going to do it, because we have to wait till they get their next paycheck so we can show $100 of reserves.
Oh.
Yeah.
$100. Like,
Wow.
are
That's
you
tight.
really?
That's tight.
We don't have any.
Yeah.
We have no margin.
You can't change
man.
light bulbs.
You can't. No, you have no margin, and so I get concerned about that when you talk about step back and just
Don't the
talk about
parameters of the program then? I mean, is it $100? Is that the parameter?
Well, most programs don't have. You don't have to show any reserves.
Oh, wow.
I was using that as an example.
Okay,
Keith, of
okay.
us having $100,
$100.
left over. But there's a lot, and then somebody, hey, we lost our job, but we're going to get a new one, and we're doing this, but yet we're buying the home, and we're getting $40,000 or $53,000 was my last one, $52,500 of free money. Now, all of that, by the way, you pay back. That isn't free money. It's like, where's that going? How do I?
When does it get paid back and how?
Yep, because that's a really important question, because that's going to be the shocking thing. I have a refinance right now where we're all set to go. Everything's great. It's one of these, Keith, that that I love. It's a FHA deal. And we're just restructuring the household cash flow. They called, their escrow was messed up. I'm just like, let's look at this whole thing.
Right.
We saved them 1.25 in the rate. It was great. Well, then we go get the title work, and guess what these folks did last year? They got solar panels, because they got, I don't know if there's tax deduction, but guess what the solar panel company does until that loan is paid off?
Lien the house.
They put a lien against your house. So now guess what? I have to get a subordination.
Oh.
Now we have to readjust, right? Because that's a debt that's tied to that property. I'm like, and I said, did you realize they're putting a lien against your property? And they're like, oh, there's no way they did that. They, just in disgust almost, right?
Right.
That someone would do that to them.
To them.
Yeah. And then they called and they said, well, yeah, it's right here in the
course.
paperwork. And then they pointed out where in the language.
In the contract.
Yeah. Yeah. So that's not great.
Yeah, it's not great.
Right. So we had to readjust. No, we still got done. But there again, you're ready. You're trying to close this thing. Well, it takes us, about 20 business days to get that subordination agreed. Because God forbid anybody works fast.
Yeah.
Right. To get this stuff done. Right.
Right.
Just shocking to me a little bit.
Shocking.
Anyway, there's my rant. Escrows. I wanted to touch on escrows real quick. Getting way too many calls on escrow accounts. People thinking that their mortgage interest rate changed because their payment changed.
Oh yeah.
I got a question about escrows.
Okay. You want me to? Let me just finish real quick. So,
talk fast.
So taxes and homeowners insurance. Taxes and homeowners insurance. Those are the items that go up. Your principal and interest do not go up.
No.
So when you call and say, "Hey, why you said my interest rate was fixed?" This is, and people get really
Irate.
Passionate about
Yes.
it, and I like to use the word passionate. I'm like, no, did you look at your tax assessment? Well, yeah, that said it went up, but I'm just like, yeah, that's where it is. And homeowners insurance, my God,
Yeah.
Dave,
I'm sorry.
you guys got to stop it.
Wow.
So anyway, those two things. What question did you have?
Well, it has to do with the escrows. We used to do for carpet escrow. So we're going to buy the house, but we need escrow for carpet. Can't do that anymore.
No.
But a rehab loan you can do.
Yeah, or use your program over at CBB.
Exactly. And
That's a better way to do it.
And get that money in there and get it taken care of.
So.
But you cannot do escrows.
No.
No escrowing for carpet.
No, not for that, but outside stuff during the winter you can.
If it's
landscaping,
required by the
all
lender.
that,
Yeah.
So.
If it's and approved by the lender.
Anyway, give me a call. Let's have a conversation. I'll be really nice and kind, and we'll have a pleasant conversation. 651-231-2500. Again, 651-231-2500. Remember, a free 1-0 buy down, so start up 1% under the market.
That's it for this week. We'll see you next week.